Check your hair. Still got some.
It's too late for mine.
Okay.
We're good to go. Wonderful. Hopefully that small pause didn't cause any issues. Delighted to welcome everybody to our Executive Search M&A webinar. And delighted to have been invited to facilitate and host this webinar by Tim and the panel for today's session. Executive Search M&A is a topic that I've spent the last 25 years or so being very involved with. And I know the panel are going to be very keen to share their thoughts and bust some myths and answer some questions on this topic. By way of introduction for myself, Katie Falwell-Davies, I've spent my career, the last 25 years at Deloitte, where I led our M&A practice around human capital and spent a lot of time advising businesses and owners and entrepreneurs around M&A within the executive search space, having been involved in a huge array of different transactions, from large transactions like Whitehead Mann to very entrepreneurial search businesses. I've been involved with very sector-specific transactions in the legal search space, public sector, and I'm delighted that we can have this this opportunity to sort of talk about this topic. I'm going to ask the panel just to introduce themselves. Tim, should we start with you and just give everybody some background, and then we'll work round. Gray, perhaps follow, and then Philip, if I can ask you to follow. Tim.
Cool. Yeah, no, thanks, Katie, and thanks so much for sharing this. Really appreciate it. So I'm Tim Connolly, the founder of ALC Enable. Started the business back in 2001, so 21 years ago. And we've become now the business solutions firm for the executive search industry globally. So what that means is we provide all types of strategic advice to executive search firms. So that's everything from we coach and mentor search firm leaders. We provide help with marcoms and branding and broader strategic work. And we have experts in 5 countries around the world helping executive search firms around the world, big, small, medium size. We've worked with all the big 5 search firms, including Egon Zehnder. And we also provide scaling opportunities for search firms as well. So talent acquisition, so hiring individuals and teams, but also something we've been doing a lot more of recently. And I see a big trend for it over the next 12, 24 months and going forwards from there, mergers and acquisitions, which we're here to talk about. So that's a really exciting growth that we're seeing. We're excited for us, but we're also excited for the search industry as well.
My name's Gray Hollett. I'm part of ALC Enable as well. I've joined Tim about 6 months ago, working with Tim with clients on a range of issues, from brand strategy and business strategy work. My background of years as a strategic brand consultant, working at some of the large brand consultancies and a couple of small ones as well. And then I spent nearly 14 years with Boyd & World Corporation, heading up their business strategy as well as their chief marketing officer globally. It certainly is an interesting moment in time, I think, for executive search. The activity out there seems significant, and the desire for increased activity is significant. So we're really excited to talk about M&A today.
Thanks, Gray. Philip, over to you.
Afternoon, everybody. Thanks, Katie. So Philip Ellis, founder of Optima Corporate Finance. We're a corporate finance boutique based in London, and we work exclusively in the recruitment, search and human capital sectors, advising on M&A transactions. My first deal in the sector was 26 years ago. For the last 16 years, I've worked exclusively in this market. So we've seen lots and done quite a lot. many of the transactions we've been involved with have been in the contingent recruitment space, which I guess is where the larger volume of transactions have been. But increasingly, we're also seeing more activity and interest in the exec search market. And for that particular reason, we're partnering with Tim and Gray at ALC to work jointly, so to bring a combination of ALC's knowledge and experience of the sector and our corporate finance expertise as well. So I think if every deal we've ever worked on has been different and has brought up its own quirks and peculiarities. So there's no book that gives you the answer, and hopefully the experience of the people with you today will give you some good insights into what it's all about.
Fabulous. Well, look, we've got quite a broad range of participants today. We've got some participants from larger search practices, entrepreneurial search practices, quite a broad remit. And I'd encourage everybody to use the chat function as we go through, because whilst we try and cover a broad spread of topic, it would be great to get some questions to make sure that everybody gets absolutely the most out of this webinar as possible. So please be interactive. We can see the chat function, or at least I can see it on the right hand side of my screen. I thought we'd just kick off. Earlier today, I was in the city, one of those days where I'm actually going into the city. And I about a year ago, I moved away from the advisory side to the investment side, and I was actually with an executive search business, and we were talking about some of the reasons why search practices do M&A or want to be involved in M&A. And I thought we might kick off by just sort of looking at some of the bigger themes that we as a group have been discussing in terms of, what does drive M&A. Does anyone want to kick off with this question just to start with? I don't know whether, Tim, it's a conversation I know will have had with lots of people. So why do you think this topic is has been required and people want to hear about M&A?
Yeah, thanks, Katie. That's great sort of intro to it, because I think 5 years ago, or even 2 years ago, we wouldn't have been able to have a webinar with so much interest, and because there is more interest in it. I mean, I wasn't particularly, going back 3 or 4 years ago, it wasn't a big subject for the executive search industry. I think one reason is that talent's so short now. I mean, 2021 was probably the most successful year in Europe and the US, particularly on record for the executive search industry. And if you're looking to scale, it's very difficult to attract talent. So since there now is an opportunity to realize value in executive search, which I'll come back to, it seems quite an efficient and cost-effective way to find a business with 5 partners or 10 partners, or however many partners it is, rather than sequentially hire those on a one-by-one basis. So it's going to be a lot more cost-effective and time-effective to find a company that will be happy to merge or be acquired. And I think it's more possible now, because I think there are recurring revenue models in executive search that there weren't before, in coaching and assessment, in organizational consulting, and in interim, of course. There's been a massive growth of interim. Plus, there is, we have seen subscription models even in the executive search. I think there's lots of very kind of agile models with annual subscriptions in executive search, which is interesting. So I think it's easier now to transfer value than it was. And I think now search firms, the final reason I would say is that search firms are now realizing that the good times, are not going to last forever. And scale is not necessary all the time, but if done in the right way, it is quite a strong way of future-proofing yourselves against your competitors who are sharpening their brands and sharpening what they're doing, I suppose.
Yeah, the scale point, Tim, I think is really, it's interesting. We see, I've seen, a lot of businesses, as you say, who want to scale their businesses and as you say, speed-wise, pulling together like-minded or indeed adjacent firms can create scale. And we've seen that there are a number of models that have done that. I think you're absolutely right that there has been an increase, certainly in M&A activity or interest in M&A activity. The recurring revenue model, would anyone like to pick that up, Philip or Gray? It's a really interesting piece because, as I'm sure we'll come on to, it's been challenging sometimes to get the value that people feel their businesses are worth. This changes quite a lot of that, I think.
I'll quickly respond. I think the recurring model it's kind of expanding the search firm's capabilities, right? And it's being generated from client demand. Clients are demanding that kind of knowledge transfer from search professionals on other areas of leadership consulting and talent development. But also, I think some of the other things you see is the M&A activity is focused on accessing other sectors or other areas, things like DE&I and sustainability and firms with that type of expertise. But a lot of what you saw, particularly last year in 2021, were a number of deals that revolved around acquiring those ancillary services, those recurring revenue models of, things like culture transformation and that type of thing. ZRG last year acquired, I forget the name of the firm now, but a pretty good deal on acquiring a cultural transformation firm as well. So there's a lot of that kind of expansion of that activity within kind of the talent advisory space.
Yeah, I think following on from that, the sort of market intelligence and other sorts of coaching and other sort of revenue streams has a double impact. Firstly, it makes those client relationships more sticky. I think that's a phrase that we've heard. It's not just about finding a bum, however senior that bum might be, and placing it on the seat. It's about consultative type relationships with clients, and because that makes it a stronger relationship, that translates to value. So I think it works in a double positive way, that it sustains those relationships as well as building value.
I think it's a good point. I agree completely. The other part of that is kind of the evolution of executive search from what years ago was a very transactional business to a much more consultative type of relationship.
One of the questions I'm often asked is do you stay pure play, or do you broaden out, multi-sector, multi-geography? The point around going into different areas. Maybe that is, whether it's coaching or outplacement or some of the things we've discussed. Does anyone have a view, maybe on value or indeed ease of transaction? Is it easier being pure play, or does it help to be a bit more multidisciplinary?
I'll take that first, if I may. I think, unsurprisingly, there's no single answer to that. But I think what's important is, if a business is anticipating selling and realizing value at some point, they need to keep in mind that there needs to be a selection of potential acquirers that will find their activities attractive. So diversifying into complementary areas makes sense. So if, for example, you're in one of the professional markets and you move into another professional market or something closely associated, that would make sense. If you were to move into a completely unrelated area, that might make a transaction more challenging, just by virtue of the fact there won't be many acquirers that would find all of that business relevant and interesting, and therefore they might start to discount part of the value. So I think diversification is okay, not just for the sake of it, as long as it makes sense. But generally, I think a specialist is more valuable than a generalist. So being known for something and having a strong market presence and brand in one particular market would probably command greater value than a business spread across multiple sectors.
Yeah, and it's interesting. We've got a question here from Ian, which is, I think, quite pertinent at this point. So the question is, if you were to advise an ambitious emerging brand on how to scale over a 2 to 5 year time frame, ready for a potential trade activity or sale, what type of profile of recruiting and human capital business would be attractive and guide the business to scale towards? So Philip, I mean, your view, value wise might be, you might get a broader range of buyers at a higher price, possibly, if you are single focus. Of course, it's not as easy to scale necessarily always, so pure play. Any other views from Tim or Gray around Ian's question? How best to scale over a 2 to 5 year period to be ready for a trade buyer?
I think it's a difficult one, isn't it? Because Philip's got more expertise than me on this subject, and I'm sure he's absolutely right that niche is good, but you're not only when you're running a business and scaling the business, you're not only looking at the exit, you're looking at other factors too. You're looking at you're keeping the business going over those few years. And I think what I hear, and the audience will know this better than I do, because I'm sort of 2 stages removed, but what I hear from executive search leaders that they hear from their clients is that actually being more holistic about their offering is more and more important these days, with other talent services, with interim coaching, organizational consulting, and so on. I just wonder, and this is probably a question to throw back at Philip, but I wonder if there's a way of scaling, being quite versatile in your offering, perhaps internationalizing, but then some way kind of creating value at a later stage by perhaps is there an opportunity to sell off parts of the business, or is there another way of doing it, I suppose?
I think we need to distinguish between vertical and horizontal expansion, and to put that into context, what I mean is if you're in a sector, let's choose finance for ease of conversation. If you're providing services into the finance sector, that can be a whole range of services apart from the pure play search, some consulting, some interim, all sorts of other services. What would be less easy to then realize value would be if you were in the finance sector and you moved into the engineering market, for example, where you wouldn't see any natural synergy. And so to find somebody that was excited about buying both parts of that business would be a bit more challenging. And then you run the risk of either having to break the firm up or sell part of the business on a discounted basis. So keeping it all packaged up neatly for a buyer is what I would recommend, but that doesn't mean only one source of revenue, but it probably does mean one market or closely allied markets.
And Philip, for the I'm taking Ian's point. I found it a very good question for the time where we are in the session. I mean, obviously, the advice from the corporate finance community is often making sure you understand, if you're on a sales sort of route, making sure that you understand what the buyer wants. You might have the best business in the world, but if nobody wants it, it's not very valuable. Any thoughts in terms of what are the trends at the moment in terms of what buyers might be looking for in terms of the executive search arena? Are there particular segments that people are looking at and thinking, maybe digital or something, or what's everybody's view? What's hot at the moment?
I'll kick off if you like. I think that was directed at me firstly. I think anything around digital and technology is absolutely hot and will probably continue to be so for a while. But because the market's quite buoyant and active at the moment, I would say there are buyers for all sorts of different businesses, and there'll be many people listening today that may not be in those technology sectors. That doesn't mean for a moment that there won't be interest in potentially acquiring your business. As Tim said earlier, that acceleration of organic growth means that in every market there will be businesses of different sizes, and medium-sized businesses like to acquire small businesses, large businesses like to acquire medium-sized businesses. So any sector that you're in, there will be potential acquirers, but that doesn't mean that every business is valuable or attractive. And so I suppose one of the principal challenges, particularly in the executive search market, is the idea that all of the value resides in the owner or owners of the business, and how realistic is it to assume that somebody else is going to pay a sum of money to buy the business from you, when actually the business is all about you, the owner, what's left behind. So what's really important, I think, is transitioning that across to other members of the team. Let's call them second-tier management for the sake of this conversation, making sure that the business isn't all about the owner. That starts to create value. And I think there's a massive distinction between creating revenue and creating value. They're not necessarily the same. And making the business transferable and transferable value to somebody else's ownership is one of the key things to be thinking about.
Yeah, and it's like we all know, it's a jigsaw puzzle. It's quite, in some ways it's quite a straightforward jigsaw puzzle. In some ways it's a complex jigsaw puzzle. I suppose one aspect which we haven't touched on is level, in terms of average level of appointments, assignments. So 95% of executive search firms around the world, of all sizes, deal at most levels. There's only 5% of search firms in the world that deal exclusively at board level. And we recently completed an M&A mandate in the UK, where we found we were representing Tyzac, a UK board level focused search firm, who were looking for an acquirer, and we found Mitchell Lake in Asia and Australia, who didn't have a presence in Europe and wanted a presence in Europe. So there's the geographical fit there. There's a geographical impetus there. And they also didn't deal or focus on board level, and wanted to get up to that level. So that was the perfect fit. So, I think it's very much on a case by case basis, but I suppose, so geography, sector, functions, and level, I suppose, are some of those areas, as well as potentially we are seeing more interest. And by the way, we speak to 200 search firms every month now around the world, predominantly in Europe and the Americas, but also in Asia and the Middle East and Australia. And 75% of search firm owners are planning some kind of exit in the next 3 to 5 years, which is astonishing. Whether they'll all be realised or not, I don't know. But I predict that we'll be seeing a lot more M&A activity over the next 24 months. 3 years ago, only 5% of search firm leaders we spoke to were planning an exit, and now it's 75%. So the appetite is extraordinary, and we are seeing appetite for acquiring niche talent businesses like market intelligence businesses, for example. So search firms acquiring market intelligence businesses, and to some extent the other way around too. So talent businesses acquiring search firms. So and then there's the contingency space, of course, and the hybrid space, which we haven't touched on, but there's activity between all three of those hybrids, executive search firms and contingency firms, or staffing firms as they're called in the US.
And Tim, Steve's just asked a really good question, which is around, how much is culture a barrier or a success factor to M&A? Thinking about some of the legacy businesses and then some of the more contemporary search firms that have come up and developed. How important is culture? Do we think?
Yeah, I think I mean, I think it's fundamental, and I think, I think Katie, I think you and Philip have got more experience of doing deals over the years, but I think from what I hear, it's often been to do with culture or not looking at the cultural side of things closely enough that deals have failed in the past. I think to give you a live example, I can't sort of disclose who they are, but we're working with a Californian executive search firm at the moment who's looking to be acquired, and culture is everything to them because he's something we haven't touched on yet, which is succession planning, and that's a good reason for M&A. If you're looking to realize some value and not just close your company down like you used to have to, so having a transitional ownership. As you sort of step back from your duties and your sort of responsibility as a leader, it can be a good way to exit. And my client is very much looking at culture because he wants to carry on working over the next 5 years, but he wants to work less and less. But he wants his last 5 years working to be happy years, and financially, it's only going to work if that cultural fits well, right? So actually, looking at culture first and foremost if you look at that hand in hand with the financial side, that can be a win-win.
I think culture and brand, become extremely important there. Philip was talking earlier about value, and the value often resides in the founder or the partner group themselves as their personal brands, right? But the other challenge I think we see a lot is how do you transfer that goodwill of the partner brand into the company brand to increase value? And culture is of course an important part of the brand itself. How does the culture get defined? So,
well, we're going to. I think there's a really interesting segue. So I'm desperate to get to Jay's question, which is around value before it disappears up my screen. But when we talk about culture, one of the, and I think we'll come on to it, and it does lead into value. One of the things that I've often found being a sort of really granular bit around culture is the remuneration structure. And you can find two businesses in similar sectors and similar geographies, and maybe one is more contemporary, one's more legacy. And indeed, we had this situation very much when I was advising Whitehead Manor a long time ago. Is the remuneration a commission-based structure for individuals, or is it a more professional services team-based structure? It's a cultural aspect, but it leads to value as well. If we got any views on the panel around how do you mix that sort of really granular cultural aspect? What are the issues there? Any thoughts on that?
Do you mean, sorry, I just want to make clear I'm going to answer the right question. Do you mean the link between the remuneration styles and how that flows into value?
Yeah, I mean, it's a cultural aspect. Yeah, I mean, the way the way firms remunerate is partly cultural. It's a financial cultural topic, and very often that can be a barrier to M&A. People feel that's going to be a clash. Perhaps some experiences around what's happened. Can you continue to have different remuneration policies? Just an interesting topic.
Yeah, I think it's crucial actually, because of course everybody's very sensitive to this type of topic, and any sort of change makes people nervous. I'm not talking about owners here, but the team, which is of course aspects of every transaction. And so a buyer would typically want to create as little change as possible in the early stages. And if you start shaking up remuneration arrangements, everybody's going to feel they're at risk of being worse off. A few people would think that's a good thing, even if ultimately it might be. So trying to put two different types of remuneration cultures together is pretty challenging, because whether one likes it or not, people talk. And if someone from the old firm finds out that someone in the new firm is earning in a different way, that's pretty risky. So how that flows through into deal value, I suppose, is that businesses which are individual commission type business remuneration structures may be less professional services type, and therefore more contingent recruitment type perception, whereas the professional markets, where it might be more team based, those businesses may be valued in a different way, linked to revenue as opposed to linked to profitability. And this is a whole different complex area, but it would be quite difficult to mix those two types of cultures in a deal without some very careful management.
And Philip, I mean, Jay's raised this question. Very interested to understand valuation metrics within the search world. Lots of people very aware of EBITDA multiples in more contingent businesses, but if we were going to sort of talk about how search businesses are valued and what the components and the different perspectives are there, the dynamics, what should we be really thinking about?
Well, surprising that we're half an hour in and just over, and I haven't used the word risk yet, because it's probably the word that I say most in these sorts of conversations. But actually, these deals are all about risk, and valuation is all about risk. So, as we said before, if all the value resides in an owner, that's a different story than if they have managed to build a well-functioning team where the revenue is spread. And similarly, to take an extreme example, that if the business had all of its revenue dependent on one client, that would be regarded as extremely risky. Now, nobody runs their business in that way, but we'll take the point. So the risk factors associated with the business have a huge impact, both on the absolute value and the structure of a deal. So how much money an acquirer would pay up front against how much would be deferred. But the principle, I think, is that it's likely to be linked to revenue. And therefore, I suppose a broad brush start point would be 1 times fee income.
Which is what the Shreks use. I mean, that is it's always been the yardstick, hasn't it? The 1 times net fee income.
Yeah, and then I think it's plus or minus depending on those risk factors and the specific features of any given business. So if we sort of said 0.75 to 1.25, maybe 1.5, that sort of range, it's likely that lots of businesses would fall into that. And I suppose as a sanity check, then seeing what that equates to as an EBITDA multiple, just to see if there's any market reality in that type of valuation metric. We would expect typically that there would be.
And are we still seeing a lot of earnouts? They're always very, very difficult to deal with if you're trying to integrate businesses. How do you keep measuring them separately? But are you seeing still a high level of earnout?
I think almost exclusively on every transaction, there's an element of earnout because of that word again, risk. Which buyer wants to pay 100% of the value up front? What they really want to do is make sure that they're getting what they think they're getting and that the business continues for a period of time, particularly if there are departing founders. So I would say almost always we'd expect a degree of earnout to be part of a deal structure.
And Philip, obviously there are a number of routes to M&A, and what types of structures. There's been trade purchases talked about in the questions. Before I go, Jay has asked, what's the typical earnout period? I'm not going to let that disappear, that question. So are we talking 1 year, 2 years? What's your experience?
Typically 1 to 2. I think any less than that doesn't really allow much time for reality to play out. And any longer than that becomes unmanageable. I mean, you alluded to it already, Katie, that a buyer wants to wrap their arms around the business they've acquired and integrate it. And the seller wants to keep the buyer as far away as possible during the earnout period so they can just focus on delivering whatever it is they're tasked with delivering through that earnout. So keeping it.
And that's sort of the cash earnout situation. Obviously, you can get longer buy-in if you are dealing in a some sort of buyout or share where the owner has got some shares in the business still. What sort of structures are we typically seeing now? Is there more trade activity than private equity?
I've always done majority of the deals I've been involved with have been trade. And when we talk about equity, let me clarify, there's two possible areas there. So firstly, a buyer buys, let's say, 75% of a company and the owners retain 25%. So they've got carried interest in their own business. Or the buyer buys all of the business, but they pay partly in cash and partly in shares in their own business. So the sellers become shareholders in the new company. There's no right or wrong. There's no better or worse. It depends on the motivations of the sellers. And if they're not looking to leave, but just want to be part of something bigger, then making them shareholders in that larger top entity can be very incentivizing and ultimately can create a lot of value for them.
Right.
Yeah, and we as we've talked a little bit about some of those valuation dynamics that we talked about. Philip, you raised customer concentration, and we've talked about obviously the name above the door perhaps being the main fee earner. Are there any other pitfalls around transactions that cause deals to fall over? What else? Obviously, through the due diligence or even the negotiation stages.
I've got one quick one on that subject. So it was interesting about the compensation alignment or the sort of cultural alignment, which I think you're right, Katie. I think compensation, the way people are paid, forms part of the culture. And I think what this comes back to, and we just must remember that the executive search industry is really new at this M&A business. So all of these questions, it'll be really interesting to hear what the answers are, on valuations, for example, in 12 months' time. Because if the appetite of 150 search firms a month that we're speaking to, if that translates into any kind of reality in terms of deals done, then we're going to be learning a lot. And we're certainly learning a lot at the moment from the deals that we're doing, but from the firms that we're talking to. But I think what it comes down to a lot is setting the stall up right. So I think deals that have gone wrong in the past, and this is maybe true of the contingency industry too. I don't know that industry so well, but with the search industry, it's just not doing due diligence, not looking at the culture, and compensation comes into that. So maybe it's a difficult one, compensation models. But maybe there's a way of addressing that before any transaction. But there's certainly ways of looking at the way you're set up in terms of structure, and that can be financial structure as well, in terms of kind of optimizing the opportunities in terms of numbers of suitors and I think the valuation to some extent, because I think presentation does count. But to come back to your question, one instance that I've seen of a deal not working was a firm having a similar thing to compensation in a way, having different processes in terms of the way they work. I would sort of caveat that by saying all search firm leaders that I speak to are very proud, rightly so, of the way they work and the way they operate, and think the way they operate is unique. I hear that every day, and I'm sure they've all got some fantastic strengths and run by very smart individuals. But let's face it, executive search firms, their businesses are much more straightforward than their clients' businesses, really, in reality. And most of the processes are very similar. Maybe you might pay more attention to certain things than your competitor, but one issue that did divide two firms and did stop a deal from happening was, my client was actually very proud of the fact that they wrote 5 or 6 page profiles of candidates, and the other firm was much faster and speedier, and they didn't pay that attention to detail. So those are things that again, those are sort of cultural things. Processing comes into culture as well, I suppose. But getting that alignment, I would say, at the beginning, before you're looking at too closely in terms of a deal is probably quite important, because those things do matter.
Just coming back to the point of succession, and a huge amount of the search firms out there, are not the big corporates. They are owner-managed businesses, and the owners looking for succession and liquidity event. One of the ways that some businesses have looked at M&A is into the business. So the fee earners and consultants of the business buying out, effectively the management buyout route. And I do think that has a lot of merits, keeping the culture going, and also that some of the difficulties I think we've seen just being able to raise enough money. Management teams often say, well, how on earth could I possibly buy out the business? We don't have any money. Philip, I know that is a question you will have been asked many times, and there are structures to help a lot of businesses achieve a capital event that way. Is it worth just spending a couple of minutes just detailing what we mean by that?
Sure, certainly, yeah. I think it's a relatively common route, and we're seeing even more of it in the contingent world, and I expect it will continue and translate across into executive search as well. The reason that, that management buyouts are popular, I think, if owners have worked with the team and value their contribution over a period of time, they may feel actually they'd like to give those people the opportunity to take ownership of the business as a reward for their efforts. It minimises disruption. So from a client perspective, it's continuity, so less transaction risk, and it re-incentivizes the team that have been working in the business to feel that they're going to actually be owners of something rather than employees, and that is a change in mindset. So yes, it does take some capital commitment, and I think people need to understand they do need to make some commitment. But as Katie said, I've never met a management team yet that was sitting on the cash to buy the business. So there are financial structures out there to assist with that, either in the form of debt. So we're not necessarily talking about the high street banks here, but debt funds that can help to provide that sort of funding, and or private equity. That's a whole separate webinar of its own, so we won't drift into the detail of that. But there are ways that those deals can be structured. And what I've heard from prospective management teams looking at these types of transactions before is that, well, we're going to spend the next 4 or 5 years paying down the debt or paying off whatever it is we've had to raise. And whilst that might be true, what you shouldn't lose sight of is the fact that at the end of that period, they will then own that business. So created value, and it's that transition from income earning to ownership of capital value, which I think is crucial. And generally we find that whilst owners who are looking to exit might be prepared to discount the price a little for a management team, or maybe not, where there is usually a bit more flexibility and support is over the terms of payment. So they may not expect their management team to pay in full as quickly as they might expect an external trade purchaser. So those softer terms can help to support the transaction as well, in terms of allowing more time for the management to pay, therefore potentially generating some of that cash out of the operating cash flows of the business.
Well, and Dan has just asked a question which I was also just about to raise, Philip. I mean, we've seen hybrid models of what you've just talked about in terms of vendors actually providing a staggered earnout. So they take a little bit of cash off the table, so the business doesn't have to borrow too much money. As the business goes along, they keep going. I guess one of the ultimate pieces is the employee ownership trust, which is a term that's sort of we've seen quite a bit of just recently with one or two high-profile businesses going down this route. Does anyone have any first-hand experience of the employee ownership trusts, how they operate? Just I know certainly there are some technical hurdles that one has to overcome. Philip, have you been involved in EOTs?
We've discussed some. I haven't completed an EOT transaction. I did see
tough to do, I think, aren't they?
I did see an announcement today that SSQ have completed an EOT transaction, actually.
My old client. There you go.
That I think will help to raise the profile as well. I have to say, I'm not sure whether that's peculiar to the UK market, this structure, and I know there are some specific tax breaks, but effectively, it's a way of getting the business into employee hands, but through a trust. And I think it's still relatively novel in the human capital world. And personally, I haven't come across any in the executive search market.
Yeah, I've seen it, as you say, a couple. I mean, it's interesting, as I understand it as well. I mean, there are quite a lot of legal and regulatory sort of ramifications and hurdles you've got to get over, not least demonstrating that control has passed totally, and it may therefore be that the owner has to give control, operational control and board control over to the employees without having received all of the money. So certainly I'm not saying that is what SSQ have done. Know those guys well, unlikely. And but certainly I think it is an interesting one for the search community to have a look at. Can I just ask, because I've had a couple of questions now from Danilo, and wanting to get a bit of a view really on the African market and whether the African space for exec search is something that is getting some traction, either from search businesses wanting to enter that market, that geographic market, or indeed for African businesses expanding out. So, any comments on that from the panel?
I'd just say, it just hasn't come up on the radar very much. It's something that I don't know too much about, but I would know more about it if search leaders brought it up. Admittedly, we're mainly talking to search firm leaders in Europe and the Americas, but we are talking to them in the Middle East and Asia and Australia too. We have done work in South Africa. That was about 5 or 6 years ago, and I hear that the market has grown in certain African countries in executive search. But I'm sorry, Danilo, I'm not close enough to really know. But it's not really come up on the radar much, I'm afraid.
Yeah, I think the focus has traditionally been in South Africa and Southern Africa, and I know that there's a rapid expansion into Kenya and Nairobi in particular as well. But I don't have a lot of knowledge there either. So.
Yeah.
Okay. So we talked a little bit about valuation. We've talked a little bit about structuring. Are there any other myths that we think we need to be busting today about M&A? Any other thoughts? As I'm waiting, I think somebody's typing, so I'll wait for a couple of questions to come through. But are there any other big myths that we think we need to deal with today?
I think one thing I'd want to make sure everybody is aware of is that this is a very time-consuming process, not to be entered into lightly. I think you need to be ready and prepared to commit a lot of time to meeting potential acquirers or potential acquisition targets, depending whether you're a buyer or a seller, and then going through the due diligence process and getting to know that business during that process. And a particular risk for an owner manager is that they take their eye off the ball during the process in terms of the operational side. And the last thing you want is your results to slip during the 2 or 3 months of negotiation of a deal, because you can be sure that the buyer will want to have a conversation with you about valuation and price if your current performance has slipped. So it does take a lot of time, and of course there's the confidentiality aspect as well, that many owners would feel they wouldn't want their team knowing that they're considering an exit. Not always the case, but generally that's the starting point. And so that means that you can't even share the workload around too much, and it often falls to the owner, possibly 1 or 2 trusted people to support there. So I think that's a really important thing to take into account. It's time consuming, it's draining. I haven't met anyone yet that said, "Oh, I really enjoyed that process" at the end of it. Hopefully it's worthwhile, but you need to take a deep breath before you press that button.
And Philip, whilst obviously you and I both from the corporate finance side, albeit I've moved to the dark side of investing now, but I think the role of an advisor is very key, not only in that preparatory stage and helping provide some structure, but also being able to help sellers particularly, prioritize what the key bits of preparation are, but also making sure that if there is a queue of buyers lining up, that some screening can be done, some due diligence, reverse due diligence on those buyers. Can they afford it? Are they serious? The last thing you want is a whole load of people coming to look at your business on a fishing expedition. So I do think the role of advisor very, very important there. Any other thoughts in terms of buyer and seller behaviours, anything like that?
Thanks, Katie. I mean, I would say Philip's absolutely right, and he's got decades of experience of this. I mean, I think absolutely preparation, setting the stall out and committing to that. But obviously, if you've got an advisor, then that's going to take away some of that time from you, and hopefully support you with the negotiations as a third party as well. But my one top tip, which is an obvious one really, but is how deals have gone sour in the past, is that firm that offers you something for your firm is probably not going to be the best offer, and you wouldn't take a candidate that applies to you and think that's going to be the best candidate just because they're interested in you. I think because the market's being incredibly immature in the executive search industry in terms of M&A, it's very flattering to get an offer. But what we can do, and what you can do yourselves if you've got the resource to do so, is look at the whole market to get the right cultural fit, to do the preparation, get your financial structure to a kind of neat and kind of ready level, and to get your whole kind of offering right, and get a bit of a plan together, but to look at the whole market and prioritize the type of buyer that you're going to have. But from experience, it's often the most unlikely source that's going to be the best cultural, and therefore often the best financial fit for you.
Well, I'm very conscious of time, but Guy has sent in a question which I think plays back actually to one of the key themes we've talked about today, which is risk, and has referenced 2 search deals which have fared rather differently, and one deal where the business has gone from strength to strength, and another where everybody who was acquired seems to have left, and actually have the sellers of those different businesses also had different outcomes. And I think we've pretty much said that in the majority of cases, earnouts are prevalent, and I don't think that any seller, when they are selling their business, would relish the thought of the business evaporating overnight through a transaction. I mean, anything that we've not captured today yet in terms of why two deals could go so differently. Integration, maybe, one of the things I'm sure we've all seen is if there is a good onboarding, good integration, good reception for the business, you get one outcome. And of course, if you haven't got that, you don't. Anything we want to add? We've got a couple of minutes left to wrap up. We could spend a whole hour talking about each of these questions, so we'll have to do these.
Yeah, I think that's an interesting point, though, that kind of post-transaction, right? That integration and the onboarding and the merging of two cultures, because no matter what, any business, any two businesses are culturally different, right? No matter what. So that kind of integration and that onboarding and getting them together and onto the same page. Because if you're on the sales side, I think particularly in executive search, because of the immaturity of that market on the M&A side, it's you're talking about somebody's kid. I mean, essentially, right? I mean, they've built this business from scratch, typically, right? And so that type of kind of post-transaction attention needs to be carefully thought through, I think, as well.
Well, look, I think we did start a couple of minutes late, but I personally, I just want to say thank you to all of the panel and presenters, Tim and Gray and Philip. We've had some great questions from the audience. Questions are still coming in. I'm dying to see we've got Ian and Mark asking us a question. We'll see if we can, it's like a game show host where they can get in. But, really, very, very great topic, I think, and one that's going to come up a bit more often. Tim, any last words from you?
No, that's great, Katie. Thank you so much for hosting. I think it's really exciting times. As I said before, I think we'll see in 12 months a massive increase. I think we're already seeing an increase, but a massive increase in exits, MBOs, and M&A. And I will get back to, I'll look up the answer to that in a bit more detail to Guy, because I think that's a great question. And I'm quite intrigued as to why that is so as well. So I'll try and get back to Guy on that specifically.
Well, thank you to all the participants as well, and for being so interactive. Makes it much more fun and keeps us on our toes. Look, from my perspective, Tim, great, Philip, I hope you have another one of these sessions, and look forward to that enormously.
Thank you.
Thank you, Katie.
Thanks to the audience. Thanks for coming. And please email us if you've got any more questions. Happy to answer them. Thanks again, Katie and Gray.
My pleasure.
Thank you.
Thanks.
Bye.
Thanks, everyone. Bye.
Bye, everyone. Bye.